Welcome back. In a potential win for the worst industry, in my opinion, payday lending. It's like loan sharking. The president's pick to head the Consumer Financial Protection Bureau has proposed eliminating rules that limit the number of back-to-back loans that can be made. And now she wants to roll back a provision requiring lenders verify that the borrower can even repay the loan on time while covering their living expenses. But for fact's sake, it is important to understand what these loans even are and the massive risks they pose. Please watch this. Payday lending is marketed as a convenient way for millions of poor Americans with no credit to get a small loan in a pinch, so long as you have a job, a checking account, and a valid form of identification. For every $100 you want, you can pay a $15 fee and take out a 2-week loan. The industry markets these loans as a quick lifesaver when an emergency hits, almost like an advance on your next paycheck. 7 out of 10 borrowers use payday loans to finance recurring expenses like rent, groceries, and electricity, or to pay down previous payday debts. See, payday lenders make their money off repeat borrowing at loan shark rates, with effective rates averaging 400% annually, some rates as high as 950%. That would mean someone taking out a $300 loan could end up paying $2,850 in fees alone. So why is this happening? First, payday lenders say they need to charge their customers super high rates because they carry super high risk of default. Second, unlike longer-term loans, borrowers, they're expected to pay the total amounts they owe within a period of weeks. But a whopping 80% of borrowers say they cannot afford to make full lump sum payments. They roll their balances into new payday loans within the 2-week period. It's no wonder almost 12 million Americans taking out payday loans each year wind up spending $9 billion on loan fees. Even so, payday lenders insist they do not market their product as, quote, long-term financial solutions. Yet, according to the Pew Charitable Trust, the payday business model encourages borrowers to pay hundreds of dollars in fees, none of which count as payments toward their underlying loans. Critics say that kind of business model fuels a cycle of loans, renewals, exorbitant fees, and even more debt, which is kind of the point. It should come as no surprise that 15 states already ban high-cost payday lending. Why this predatory practice is not a higher priority for the Trump administration is anyone's guess. I don't get it, but I want to make it clear. The new head of the CFPB, Kathy Kraninger, please, I invite you to come on television with me, have a conversation on the record, off the record. Why are you doing this? Joining me now, NYU Stern School of Business professor, my dear friend Scott Galloway. Scott, these rollbacks, these ones blow my mind. Help me understand what the rationale could be. Payday lending is the most predatory lending to the most vulnerable borrowers.
So I'll give you the rationale, or I'll give you the talk track. And the talk track is that if you unleash this industry from these onerous regulations, that it will attract more players, and the invisible hand of competition will bring down rates and offer more products to that constituency.
Really? Because that wasn't the case before the financial crisis. These guys were the definition of loan sharks. Before they had the regulation, they weren't any better. They were horrible. That's why we got the regulation in response to their practices.
Let me be clear. I believe this is a false narrative, and there's a lot of evidence showing it is a false narrative. I mean, one number that really stood out in your piece before we began talking, Stephanie, is that the annual interest rate here is 400%. We're talking about the most economically disadvantaged cohort in America. Let's talk about the most economically advantaged individual in the world, and that's Jeff Bezos. When Jeff Bezos needs to borrow money, he borrows money at an annual interest rate of somewhere between 2 and 2.5%. So you have the wealthiest man in the world gets to borrow at 2 or 2.5%. But people who are in a tough spot and can't make their rent are being charged 400% a year. The point of regulation is to protect the governed, not the governors. And what we have here is a pay-for-play where all the people who are pulling these regulations out are getting money. Case in point, the trade association that represents this group gave money to the inaugural campaign and held their annual meeting, get this, Stephanie, at the Trump Doral country club. This is nothing but pay for play.
Corey Lewandowski had been working with some of these payday lenders as well. So if Jeff Bezos would only have to pay 2 to 2.5%, and somebody who goes to a payday lender who, let's say, borrows $300 and could end up having to pay close to $3,000, where's the midline? Obviously, Bezos gets to pay such a low rate because you know he's got the dough to pay it back. These are significantly riskier borrowers. That's one of the reasons they're in this position. So where is the mean?
That's a fair question. And what we've decided is that as a government that is focused on ensuring we don't have usurious interest rates, the government steps in and says, look, maybe you can charge 15, maybe you can charge 20%, maybe you can charge 30%. But when you intoxicate people into the notion or get them in this, put them on a path, sort of this inexorable downward spiral, where they effectively end up every couple of weeks spending more and more of their paycheck on just interest, you have something that is ruining people's lives. And the idea of government intervention, government regulation here makes a lot of sense. So you're absolutely right. Should these people be able to borrow at 2%? No. But there's a lot of ground to cover between 2 and 400%.
There sure is. Remember, regulation isn't here to stop business. Smart regulation is put in place so good business can move forward, and so civilians won't get abused and taken advantage of. Payday lending, it is a one-way road to a bad place.
Hey, MSNBC fans, thanks for checking out our YouTube channel. Subscribe by clicking on that button down there and click on any of the videos here to watch the latest interviews and highlights. You can get more MSNBC for free every day with our newsletters. Just visit msnbc.com/newsletters to sign up now.